Welcome to the Opening Bell Report.
So if you were watching the markets recently,
Yeah.
you probably did a serious double take.
Oh, absolutely.
Because we see stocks move all the time, right?
Mm-hmm.
Up 1%, down 1%, maybe a little jump on some good news.
Yeah.
But then you look at KVA Group and suddenly, boom,
Yeah.
a 26% breakout in a single trading day.
Yeah, it was startling. You really don't usually see that kind of vertical line on a chart for a company that, sells hummus and pita chips.
Right.
That's the kind of volatility you expect from like a tech startup or a biotech firm announcing a cure for something, not a fast casual restaurant chain.
Exactly. It surged right past the $85 mark. And frankly, for a salad chain, a Mediterranean culinary brand that feels massive.
It is.
It really begs the question of what on earth just happened. Did they discover some new golden chickpea?
Right.
So naturally, we had to grab the stack of reports, the earnings transcripts, and the analyst notes to just figure this out.
And it is a huge move. But what's really fascinating here is that this isn't just about one good day of trading.
Okay.
If you zoom out, this is really the culmination of a massive debate that Wall Street has been having for, well, basically the last year.
The tug of war.
Exactly. This was the moment the tension snapped.
I feel like I've been hearing this argument in the background for months now.
You definitely have. On one side, you had the skeptics, and there were a lot of them saying, look, this is just another overhyped IPO. It's just a restaurant chain.
Right. Margins are tight.
Margins are tight, labor is super expensive, and the stock is overpriced. They were essentially betting on gravity taking over.
And on the other side.
You had the believers, the ones claiming this is a legitimate generational growth story.
Wow.
Yeah, they've been arguing that CAVA is the next big thing, basically the heir apparent to the fast casual throne.
And based on this latest full-year earnings report, it sounds like that generational growth crowd just took a massive victory lap.
Oh, they certainly did. The verdict is officially in. CAVA didn't just meet expectations, they completely shattered them.
So the mission for this deep dive is to look under the hood.
Right.
We need to understand the specific numbers that triggered this explosion. But more importantly, we need to dissect what analysts are calling the Chipotle blueprint.
I love that term.
I keep seeing it everywhere, but it feels like a lot of pressure to put on a younger company.
It is, but the comparison is becoming harder and harder to ignore.
Yeah.
We're also going to look at some hidden cash flow metrics that suggest CAVA isn't just a trendy lunch spot for, coastal elites, but potentially the next true giant in the space.
So whether you're an investor watching your portfolio, a foodie who just loves their crazy feta, or just someone interested in how a business scales from a cool concept to a national powerhouse, this deep dive is for you.
Let's get into it.
All right, let's start with the headline number, the big milestone. Because CAVA just joined a very exclusive club.
They did. CAVA officially crossed the $1 billion annual revenue mark.
Unbelievable.
Specifically, they reported $1.7 billion for the full year.
That is a significant psychological barrier, isn't it?
It really is. It moves you out of the promising startup category and firmly into the major player category.
Right.
That represents a 22.5% year-over-year growth rate. But, and here's where I want us to slow down a bit, you have to look at the quality of that growth.
Okay, distinguish that for us.
Yeah.
Because from where I sit, money is money. If the register rings, isn't that just growth?
Not necessarily. In the restaurant business right now, there's good growth and there's bad growth, or let's call it inflationary growth.
Okay.
Think about the last time you went to a local burger joint. The price is up.
Well, definitely. The $15 burger is the new normal. It's painful.
Exactly. So a lot of restaurant chains right now are showing revenue growth, but if you peel back the layers, they're really just raising menu prices.
They aren't actually getting more customers through the door.
Right. In fact, their actual foot traffic might be down, but they're masking it by charging the remaining customers 20% more.
Got it.
And that is fragile growth. It's unsustainable because eventually the customer snaps and just stops coming.
Right. You hit that price fatigue wall.
Exactly.
So how does CAVA stack up against that?
This is the part that really blew the analysts away. In the fourth quarter, their revenue jumped 21.2%. But, and listen to this, only 1.9% of that came from price increases.
Wait, really?
Yes.
In this economy?
Yeah.
Less than 2% was just charging more?
Correct. And that is a massive anomaly in the current market.
So if they aren't gouging the customer, where's all this new money coming from?
It's pure organic volume. It's what they call traffic mix. More human beings are actively walking through the doors, and the new store footprints they're opening are performing exceptionally well.
Wow.
They're capturing real market share, not just squeezing their existing customers for an extra dollar.
That is a huge distinction. It implies that the demand is real. People aren't just tolerating CAVA, they are actively choosing it, despite the whole inflationary environment.
It's a huge sign of brand strength. When your competitors are hiking prices by 5, 6, 7% just to keep the lights on,
Yeah.
and you're growing 20% with barely a price hike, that tells you the product market fit is just incredible.
But hold on a second. If they aren't raising prices, surely their margins are getting crushed, right? Food costs are up everywhere, labor is up. How are they even turning a profit?
And that was the exact fear. Wall Street, with all their intricate models, expected CAVA to basically just break even this quarter.
Just flatline.
Right. Maybe zero profit, maybe even a slight loss as they spend heavily to expand.
And what was the reality?
A surprise earnings per share EPS beat of 4 cents.
Okay, now I know 4 cents sounds like spare change you find in a couch cushion,
It does.
but you have to contextualize that for us.
You do. Because when the expectation is absolute zero, and you're in this high growth land grab phase where you're building expensive commercial kitchens all over the country.
Right, which costs a fortune.
Exactly.
Yeah.
Turning any profit like that is a massive signal of operational efficiency.
It tells you the engine actually works. It's not just burning cash to keep moving forward.
It tells you the model scales. And that scalability is the perfect segue to the comparison everyone wants to talk about right now.
The king.
Yeah.
The 800-pound burrito in the room. Chipotle.
You just can't escape the comparison.
It really is inevitable. But I feel like every fast casual place for the last 10 years has pitched themselves as the Chipotle of pizza or the Chipotle of sushi.
Oh, constantly.
Usually it's just marketing fluff to get investors excited. But looking at this source material, it seems like with CAVA, this isn't just a lazy comparison.
No, it's not.
It's actually a structural business model comparison.
It really is. It's about the actual physics of the assembly line. To understand why Wall Street is suddenly throwing money at CAVA, we have to look at the absolute secret sauce metric of the restaurant industry,
Which is?
AUV, average unit volume.
Okay, let's break that down for the listener who isn't staring at restaurant spreadsheets all day long.
Simply put, AUV is how much revenue a single restaurant location generates in one single year.
Okay.
It's the ultimate measure of how popular and efficient your box is. Now, Chipotle is the gold standard here. They are an absolute machine pushing past the $3 million AUV mark.
$3 million per store annually.
Yes.
That is the benchmark.
That's the mountaintop. But now look at CAVA. Quietly, without a massive national TV blitz, CAVA has climbed to an astonishing $2.9 million AUV.
2.9. That is shockingly close.
It's right on their heels, and you have to realize just how rare that is. Most fast casual concepts struggle to hit 1.5 or 2 million. For CAVA to be flirting with 3 million implies that their throughput, the sheer speed at which they can get people down that line and rang up, is elite.
It proves that the assembly line format works just as well for Mediterranean ingredients as it does for Mexican.
Exactly.
But I want to push back on this a little bit. Chipotle has been around for decades. They are a well-oiled machine. Is CAVA really operating at that level, or is this just a new kid on the block hype bump?
That's a totally fair question. New restaurants often get what we call a honeymoon period when they open.
Sure, everyone wants to try the new place.
Right, but CAVA's numbers are holding up across their mature stores too. It proves that Mediterranean food, the grain bowls, the dips, the proteins, has the exact same mass market scalable appeal.
Which wasn't always a given.
Not at all. For a long time, investors thought Mediterranean might be too niche.
Too urban.
Yeah, or maybe too healthy.
Right, rabbit food.
Exactly. But at 2.9 million a store, that argument is completely dead. You don't hit those numbers just selling to yoga instructors in Los Angeles.
No, you definitely don't.
This is mass market adoption.
And this puts CAVA in what analysts in the reports are calling the Goldilocks zone.
It does. Think about the broader landscape for a second. On one side, you have peers like Sweetgreen.
Great brand.
Great brand, yes. But they've really struggled with profitability and operational complexity. The menu is complicated. CAVA is vastly more efficient than them.
Okay.
But on the other side, you have Chipotle. Chipotle is amazing, but it's mature. It's already everywhere. There's practically a Chipotle on every corner.
So Chipotle has less room to double or triple its footprint from here.
Precisely. CAVA has the operational efficiency of a giant, but the growth runway of a startup. They are just getting started, relatively speaking. That is the sweet spot.
Okay, I'm with you on the operational success. That makes total sense.
Yeah.
But now I have to put on my skeptical investor hat.
Let's do it.
Because I pulled up the stock quote before we started recording this deep dive, and I nearly choked on my coffee.
The valuation.
The valuation is incredibly steep. We're seeing a PE ratio price to earnings of around 73.
It's high.
It's nosebleed territory. Chipotle is trading at around 33 times earnings. So at first glance, CAVA costs more than twice as much as the industry leader relative to its actual profit.
Right.
Isn't that a massive red flag?
Mm.
Isn't this stock priced for absolute perfection right now?
It is the classic sticker shock, and you are right to be skeptical. If they stumble even a little, that stock price is a long way to fall.
Exactly.
But, and here's the voila moment from the analyst notes, we have to look at why the market accepts that premium, that multiple, that 73 times. It's shrinking fast.
Wait, shrinking because the stock price is dropping?
No, shrinking because the earnings, the E and PE are exploding.
Okay.
If your earnings double, that ratio gets cut in half, assuming the price stays the same. The market is pricing in future growth. They are aggressively betting that the E is going to catch up to the P very quickly. But there is a more critical metric we need to look at to justify this valuation, something that matters far more than accounting profits right now.
Which are
operating cash flow margin.
Okay, walk us through that. Why does that trump the PE ratio in this specific case?
Because cash is oxygen for a growing company, especially right now with interest rates being where they are. Borrowing money is extremely expensive.
Right.
If you have to go to the bank to build new stores, your profits get eaten up entirely by interest payments.
So you want to be self-sufficient.
Exactly. Let's look at the data from the report. On that 1.7 billion in sales, CAVA generated nearly $185 million in operating cash flow.
Wow. So they kept a massive chunk of it.
They did. That is a margin of almost 16%. Now, here is the strategic implication of that. We call this capital allocation.
Okay.
Because CAVA is converting 16% of its sales directly into cash, they are self-funding their expansion.
Ah, I see why this is a big deal. They don't have to dilute the shareholders to keep growing.
Correct. They are expanding their unit count by 20% in a single year. Usually, to grow that fast, a company has to take on crippling debt or issue new stock, which waters down everyone's shares.
Right, the pie gets sliced thinner.
But CAVA isn't doing that. They are building new stores with the cash generated by the existing stores.
That is a very rare position to be in for a growth company. It's like a perpetual motion machine.
It's incredibly favorable. The old stores pay for the new stores, which then become old stores and pay for even more new stores.
So that's 73 times PE.
Yeah, it's basically the premium you pay to own a machine that prints its own growth capital.
That makes a lot more sense. You're paying for the safety of self-funded growth.
Yeah.
You aren't at the mercy of the bond market or interest rate hikes.
Exactly.
So let's talk about where this machine is actually heading, because having the cash to build stores is one thing, but you still have to find places to put them where people will actually eat the food. What's the roadmap look like?
The company has been very clear about their long-term goal. They want to hit 1,000 locations by 2032.
1,000. And where are they sitting right now?
Currently, they are at just over 430 locations.
So they're aiming to more than double in the next 8 years. That is aggressive.
Correct. And the immediate future is pretty fast-paced, too. The guidance for next year is to open 74 to 76 new restaurants.
Wow.
That will push them comfortably past the 500-unit milestone.
That's a lot of ribbon cuttings.
Yeah.
But this is where my skepticism comes back again.
Lay it on me.
It's easy to open a Mediterranean bowl place in New York or D.C. or L.A. People there already know what harissa is.
Yeah.
But what happens when they go to the middle of the country? What happens when they open in a suburb where hummus might still be considered a little exotic?
That is the execution risk. It really is the biggest question mark moving forward. Can you replicate the massive success of a coastal urban center in the Midwest?
Exactly. Does the concept travel well?
Well, so far, the data says yes. They've been expanding into new markets, and the unit economics are actually holding up. Let's look at profit at the restaurant level. And remember, this is distinct from corporate profit.
Right.
Their restaurant-level profit margins are holding strong at 24.4%.
25% profit at the store level. That is elite.
It's incredibly strong. So even in these newer, untested markets, the stores are performing. Every new store they open is essentially cash positive almost immediately.
That's wild.
It's not like they open a store and it bleeds money for 3 years while they try to educate the local market. These units are highly productive very quickly.
Which explains why the analysts are scrambling to update their spreadsheets.
Oh, absolutely. The market consensus is aggressively revising targets right now. The price target is now sitting solidly in the $88 to $90 range. They are literally playing catch-up to the reality of the math.
It really feels like the market was just sleeping on this, waiting for them to trip up, and then woke up all at once when they didn't.
That's exactly what that 26% jump was. It was a realization event, a collective, oh wait, this is actually working.
So if we zoom out, what does this all mean for the listener? We've got the billion-dollar revenue, the Chipotle level efficiency, the self-funding cash flow, but we also have a sky-high valuation and the challenge of conquering middle America.
I think the summary is this. CAV is no longer a speculative bet. A year ago, you could have argued it was just hype or a passing fad.
Sure.
Today, the numbers say it is a highly profitable, self-funding engine with unit economics that rival the absolute best in the industry.
So the debate about is it real is over.
The debate is over. The execution risk is still there. They still have to go out and open those stores, hire the staff, maintain the quality, but the model, the business model is proven.
It's impressive to watch a company essentially graduate in real time.
It is. And looking at all of this raises an important question for me, a somewhat provocative thought to leave you with.
Let's hear it.
We've spent 50 years assuming that mass market in the US meant burgers and fries.
All right, McDonald's, Burger King.
Exactly. Then, maybe 20 years ago, tacos and burritos joined that club with Taco Bell and eventually Chipotle. That became the American palate.
The definitive fast food staples.
Right. But if a Mediterranean concept serving saffron rice, crazy feta, roasted eggplant can nearly match the unit volume of Chipotle, does this signal a permanent shift in the mass market palate?
That's fascinating. Like, are we watching a broader flavor shift?
Yeah.
Is tahini the new salsa?
Exactly. If the unit economics hold up as they double their footprint to 1,000 stores, we aren't just watching a stock grow. We're watching a new category king being crowned in real time.
Wow.
We might actually be seeing Mediterranean food become as standard in the American diet as the hamburger.
I love that idea. From niche curiosity to national staple.
It's a powerful narrative, and if they pull it off, that 73 times earnings multiple is going to look incredibly cheap in retrospect.
Well, there you have it. CEVA proving that you actually can make friends with salad, or at least with grain bowls, and make a whole lot of money doing it.
Indeed.
We'll be watching those next 74 store openings very closely. That's going to be the real test to see if this machine keeps humming. Thanks for joining us on this deep dive.
Always a pleasure.
We'll catch you on the next one.
Don't forget to like, share, and subscribe for more.